Welcome to The Property Perspective, a podcast by Knight Frank Australia. We'll share expert analysis from industry leaders, focus on key trends and forecasts, and bring you the latest topics shaping Australia's property market.
Welcome to the latest edition of The Property Perspective. I'm Anthony Pirrottina and I'm joined by my colleague Demi Carigliano. Both of us are located in the South Sydney Knight Frank office and we work in the investment sales team. Today we're going to be discussing a range of topics covering across the co-living, resi development and also the private and institutional markets. Hey Demi, today we're here to talk about what we're seeing in the market and some success we've had, I guess, ending last financial year and heading into the new financial year.
Yeah, it's been an interesting finish. What was, at the end of the rising of the interest rates, we kind of saw a bit of a flat line in what was soon to come, either a cut or another rate rise. So it was a bit of an interesting time for us. I think we slowly let the market kind of decide which way it was going to go. We noticed that, I guess, in the last 18 months prior, it's probably one of the toughest markets we've faced in our career. So I think coming...
That's fair to say, yeah, the last 10 years.
And I think for us, we've been through COVID, haven't really been through a GFC or a major recession. So for us, this was kind of like, in our generation, probably the first toughest part, I think, of our careers.
Sure. And there's been like a distinct change in... We went from every seller was gold because you could find a buyer to all of a sudden you had to pick your battles.
Yeah.
There's not a buyer for everything. There's certainly not a buyer at every price.
Yeah.
Like what there was.
And when we had the market firing, we could sell everything from something that was a B grade, C grade, that no one wanted asset, up to an A grade. Everything was selling.
A grades were just a beauty parade. You just put them up and people would line up to buy it.
Sit back and wait.
Well and truly gone now.
Yeah, Anthony and myself, we actually sold a few assets during COVID, and we didn't inspect them, didn't meet the owners, and we're selling them 2-3 mil above reserve, which kind of didn't make sense. And then now we're fighting the other battle where it's probably 2-3 mil less than what the owner wants. But I guess that's the beauty of our job. We got to kind of have the rise and fall in all asset classes, and I think where we are different is we follow where the market's going a lot better than most. At the moment, Anthony, myself and our team, we've sold a lot of blocks of units recently, and I think that's a good kind of conversation starter because at the moment we've sold about 5 or 6 in the last couple of weeks,
and all throughout inner Sydney. Like it's the same, I guess. The same mandate from investors looking for return and looking for exposure to residential. Certainly we've seen crazy rental growth over the past 12 or 18 months and that probably spurred it. But then there's a lot of other sub factors I think that feed into it. But you're right, Demi. Blocks of units are probably top of the list now, I'd say, with investors. And we can talk about a few reasons why that may be the case. But I think to start off with, I think it's obviously the ability to have a diversified tenant base, leases that you can easily backfill if your tenant leaves. The rent obviously gets reviewed every 12 months and the way it's going, you get upwards of 10% growth over the past couple of years. So that's certainly adding value on the way through.
And also there's an exit strategy. So if the market does fall away and you do panic and you do need to sell or you're stressed and financially you need to just relieve your debts, you can sell off 1 or 2 units to cover some of that. So there is a bit of an angle from an exit perspective, and I think traditionally what happens and what we find is someone that buys a house that uses that as a rental income or an apartment individually, they then grow their portfolio enough to then go up to an apartment block, and then from an apartment block they typically go to industrial or commercial. So there kind of is a bit of a stepping stone we find with these buyers, and I think from an emotional buyer that buys a house or an apartment as an investment, they then become emotional in apartment blocks. And that's kind of getting into our next point, is that some of the rates that we're achieving just doesn't make sense. You could easily put...
From a typical commercial investment point of view.
Yeah. Yeah, and it's like you could put $10 million in the bank and you could get double the income that you're getting off these apartment blocks. But they just choose to just buy it because it's a trophy. It's they can say to their friends they own an apartment block.
And you're banking on capital growth. It's really...
Correct.
Because when you're talking 2 and 3% gross returns, you take out your outgoings and you're not left with a whole bunch of leftover capital every year.
And you're literally basing it on growth of rents and growth of values. But what we've seen probably in the last year on year, I'd say, is most of our apartment blocks have grown maybe 15% a year in the last 2 years, I'd say is a fair average. One of our owners, as an example, he had all his leases in Randwick tied up at around $600-700 a week. Now they're at $1,000 a week. So once that happens, your value becomes, maybe $1, $2, $3 million worth more over that 2 year period just for the rents. And that doesn't even count for capital growth and what the units are worth. So it's quite an interesting time. And I think that's why apartment blocks are seen as so successful at the moment, is because people see there is a future in them. And that probably comes on to our next point.
Well, I think the other thing to talk about is who's buying them. So obviously typically it's just been a private. It was a high net worth, either in their super or buying it just in their personal name as an investment. Now we're starting to see developers buying them, which is really unusual, but it comes from the point that developing's just become really hard and really almost cost prohibitive. We're selling blocks of units for less than what it would cost you to buy the land and build a building. Probably a 20% discount in some cases. So why would you spend a year and a half, 2 years slugging it out trying to do a development when you can just buy the finished product, go on holidays and collect rent in the meantime?
Yeah, and I think developers, and I kind of feel for them. Everyone thinks, they make a lot of money, they kill it, and it's very lucrative in what they do. But to be fair, we're on the forefront and we hear every day what the developers are saying, and it's pretty bleak. To do a DA, it's taking anywhere between 15 to 24 months sometimes. Then by the time you get the DA approval, it takes another 12 months to get the CC. It's just dragging on, and then that chews into your interest costs, your holding costs, and I don't blame them. They're now just like, well, why are we doing this? Let's just park our money that we've made into unit blocks. Let's just collect the rent and maybe wait 2 years, things might get better, and then maybe we start developing again. But what we're kind of finding and it's quite scary, is that there's a real lack of supply coming through of new product. That's for sale or for rent. And I think that for us is going to get worse. And I think that's going to only turn into growing in rents, growing in, apartment values, things like that. But back to Anthony's point, the buyers that are coming through, honestly, they're from mums and dads. To one of the inspections we had recently was a couple of billionaires actually came to inspect some units because they're just like, we just want to buy, a basic block of units. So it was quite strange in some of the buyer pools. We sold someone a block in the eastern suburbs recently, and that were based in Singapore. Used a buyer's agent locally.
And we are starting to see some offshore capital come back. Yeah. That's been quiet probably since COVID time, past 2 or 3 years. But now we're starting to see Singapore, Malaysia, India, which is really interesting. And again, that resi exposure, that buyer for our blocks of apartments, which we've not had ever, I'd say.
Yeah, and look, the cap rates on these apartment blocks don't make sense, but they do make sense kind of in the inner west and then western suburbs is where they kind of make a better yield return. So you're kind of trading at 5 to 6% on some of those blocks, whereas you go into the eastern suburbs, it's 2 to 3%, which I think is more of a trophy buy than an investment buy. And what I mean by that is they just want one there. It's not really necessarily a smart decision to make, I'll find.
For sure.
But I think that's kind of it for the unit blocks. But I think this probably is a good stepping stone into why maybe co-living is taking off.
Yeah, for sure.
Probably the most interesting topic at the moment.
For sure. It's definitely this year's, the 2024, it's the magic word everyone's saying. But co-living, I guess, we've had a bit of exposure to it over the past 7 or 8 years through the boarding house market. And now that's sort of stepped up from new age boarding houses into being co-living assets. Where typically privates were buying blocks of land, building a block of 20 or 30 studio apartments. They're all fully self-contained, and then they'd rent them out and keep the building. So now all of a sudden we're seeing this trend where it's not 20 or 30, it's 100 or 200, and it's not a mum and dad developer, it's an institutional or a super fund that's funding the job. So it's definitely becoming much more of an institutional space, and I think that comes from, unfortunately, a generation coming through that it's really going to be a vast majority of them being renters. So they need somewhere to live, they want to move out of home, a studio in Sydney is probably the next stepping stone. And they're well furnished and they're nice, but that is very much a part of the market which didn't exist for us when we grew up. And now all of a sudden it's becoming a thing and is very much a reality for a lot of people.
And I think like typically what people don't realise is co-living is a newer version and I guess a nicer, cleaner version than an old typical boarding house. So when we say co-living, it can fall under a boarding house, but it's obviously a newer age. So typically when some of our clients have either built or developed, the neighbours get their pitchforks out and they start, ramping up and complaining and panic and think, oh,
who's going to live
there?
there?
Yeah, who's going to live next door?
Be?
But honestly, it's actually a brand new block of units that's being built.
From outside, you think it's a block of units, right? You cannot tell the difference.
And it brings young professionals, it brings students, it brings hospital workers, all the probably right people you need. And I think where the challenges has been for co-living is that the rents were there. Now, some of the rents that we're getting, and I'll speak kind of confidentially as possible, but some of the rents are absurd, up to $800 a week for some studios. And it's me and Anth always say, who's renting these? Like, we don't understand who, but they're paying it. So developers, institutional developers, privates, they all see this and they all want to bank on it. So I think that's very interesting because, like, I don't know, paying $800 a week to live in a studio by yourself, you got to be earning some good money.
100%. The amenity's nice. Don't get me wrong. There's common areas. There's pools. There's there's a few very well-known developers that have done some really nice co-living projects, and there's more in the pipeline. But it's not cheap.
Yeah, and I think it's only going to get worse, which is scary. But we kind of, so Anth and I have a pretty good track record in selling co-living or boarding house assets, and to be honest, 2 years ago, no one wanted to touch them. And we find that in our job, it's a kind of revolving door. 1 minute, co-living's doing well, and the next minute, it's not. We have to shift and adapt. So you'll see that Anth and myself, we kind of do a bit of a broad depth in value adds. And from our point of view, it's kind of at a level now where co-living's doing well, apartment blocks are doing well. Probably comes on to maybe development sites, residentially speaking, which I'd say is probably the weakest out of the three.
Oh, I think anywhere, obviously where we work, inner Sydney, south, inner west, eastern suburbs, those markets, they're definitely more defensive than what, I guess, if you go that next sort of 8+ Ks out of the CBD ring is. On the co-living front, I think the last thing to say is probably before, and when I say before, maybe 3+ years ago, there was no buyer for the end product. It was difficult to get a private to pay 15 mil plus for a co-living or a boarding house asset. Now all of a sudden, blocks of units have caught up in some regards. It's very hard to buy a block of units for less than 7 or 8 mil, particularly in our markets. So you then say, well, if you're prepared to spend 10 for 12, 13, 14, you can get a boarding house or a co-living asset that's going to generate you probably 50 to 70% more income every year. So your cap rate's much higher. And effectively, when we take you there, it looks exactly the same. So that's where now all of a sudden that market's found its legs because there's buyers for the end product. Add to that institutional players coming into the market, and they're more than happy for them to spend 20 mil, 25 mil on an asset is to do that in the blink of an eye. Yeah. So all of a sudden there's a lot more depth of market. So people are more confident to take that job on, to do a co-living development, because they know at the end, if I have to, I can sell it. There's a buyer for it. We didn't have that before.
That's true. Yeah, probably 4 or 5 years ago, it was maybe very difficult.
It made sense, but who was your buyer? If you needed to sell, there was no buyer at the end.
And still today, in 2 years' time, it could be the opposite. It could be a situation when no one wants to buy boarding houses or co-living assets, and you can't strata it off and sell it down individually. So there is an element of risk to it, but there also is a more attractive yield than it is, say, an apartment block. And I think from our point of view, that they're two different buyers. You'll never find someone that buys an apartment block is the same as buying a co-living asset. They're completely different.
It's so true. And our co-living owners own 3, 4, 5, whereas blocks a unit, often they only own 1 block of units, right?
Yeah. We have people that own up to, call it 600 to 1,000 keys. And when we say keys, it's studio rooms. And that's one private owns that. So it's quite impressive that some of these people have been doing
the scale they've built
years. Yeah.
is incredible.
And the 30% growth in rents is, for them, it's millions and millions. So for us, it's an interesting time, and if you were to kind of guess where it's going to go in the future, I think co-living will go for a longer period just because the supply is a lot less. I think as soon as the uptick in development starts improving and 1 bedrooms come back into the market, 2 bedrooms come back into the market, and there's a lot more available, the rents will slowly match or be closer to what the co-livings are at. And I think then it might deter from them, but who knows when that's going to happen.
Well, let's talk about that.
Yeah.
So a 1-bedroom unit, if it costs you 600 grand to build it,
Yeah.
add in a couple of $100 grand for the land,
Doesn't make money.
you've lost a lot of money.
Correct.
Before you take into account your time and effort and wanting to get paid for
Yeah.
for the 2 years of work.
Yeah.
So that's why that part of the market's near non-existent at the moment.
And I think, it's like, again, I go back to I feel bad for developers. I really do, because they've had the probably toughest 3 years. They've been building in, an uprise in interest rates. They've been building in an increased inflation of
It rained for about a year straight.
rain for a while, right? Then the increase in construction costs. Like these guys weren't making profits. Some of these guys were building just to get out, not to make money, and it's quite scary, right? And people think, developers are creaming it. When they come knocking on the door, they're going to come in and pay us. It just doesn't work like that anymore. And I think it's quite sad because a lot of people have gone backwards in the last 3 years, and we've been a part of that, right? That's our job, and we've been selling behalf of them and selling to them. But where I think it hasn't suffered is in that upscale development. So when we say that, like, as you know, like some ones that we've sold in around Alexandria, in the West, where they're selling 2-bedroom apartments for like close to $2 million.
Cronulla.
Cronulla. We sold something on the water. It was a large development site. It was an amalgamation play, going really well. They're selling apartments at the same values per square metre as what you would sell in Double Bay. Doesn't make sense, but they're doing well. So I think in the higher end market and the downsizer market, they're doing well and they're safe. I think when you're looking at the lower tier, middle tier, it's still very slow.
But certainly across the board, Resi Dev is quiet.
Yeah.
That's
And tough.
for sure. And tough.
And I think, it's from, like, if you're an institutional group and you're buying a development site to build and hold, and you've got a 10-year plan or a 20-year plan, it's a different story. You can afford to keep that asset for that period, and I think it's a bad idea, but I think,
so to speak, to the Resi issues that we're seeing on the development front is rezoning and widespread, I guess, the TOD and low to mid-rise housing reform. Unfortunately, in practice, what we're seeing is having a lot of people call us and say, my house is slated to get rezoned. Can you have a look at it and tell me what it's worth as a development site? We do all the numbers, and then we say it's worth more as a house. And you could kind of hear the excitement go out of their voice over the phone.
it's like we just ruined Christmas.
That's right. They think they've just won the lotto, and then you tell them, unfortunately, they're not your numbers.
Yeah, we've like, I think state government, and we get their rationale. They're trying to increase the amount of housing, and the way they're doing it somewhat is smart. But I think where it doesn't work is, like Ian said, where they've rezoned areas that are highly valued as houses, so it doesn't actually make sense as a development site, and those sites will never sell. And recently, in the last couple of months, there's been a lot of recent sites come to market. And when we say sites, it's probably been a lot that has hit the market.
More than 10?
More than 10, yeah. And they're of similar scale. And they've all hit the market at one time. So I think out of all of them, there's probably only maybe one that's been formally, I guess, transacted. But the developers can sit back and pick and choose what they want. But it's quite interesting, because I think where it's probably most needed is along the railway corridors and around areas where it's probably the house prices aren't as much as what it's worth as a development site. I think TOD will definitely work in some locations, but won't work in others.
Yeah, and we're starting to see that play out now, where even once it's gazetted, unfortunately, you can sell your individual house on a 6-week settlement, so for more than what you can sell it to a developer on a 12 or 18-month settlement.
Yeah, and I think where they probably need to focus on, and I think this is probably an important point, is fast tracking things, making things easier to get DAs, making things a bit less stringent on, CC, OC. Like, there's so many hurdles for someone to achieve a new apartment. And I think where it goes wrong is that, council is running the DA, then all of a sudden they've got a land environment court to make it faster, then it oversteps council, local council, and then it just goes on. And these developers are kind of in a point where...
Death by bureaucracy.
Yeah, it literally is. Who's got the better relationship with who who's paying more for who, and the consultants, they get a lot of money for doing this, and fair enough, so they should, but I think it just needs to be faster. I think it needs to be faster, it needs to move quicker. People need to get stuck in sooner, and for us, there's another bonus hovering around the market, which is a 30% uplift.
For affordable housing?
And we think, personally, it doesn't work.
Well, the reality is that no one knows what to do with that affordable housing.
Yeah.
So you've got private developers that are being incentivised to deliver affordable housing, but they say, well, what do I do with that 30% once I've built it? And how does it impact the other 70% where I'm trying to sell high-end product? And I've got to explain that, there's affordable housing as part of the development.
And to give you an idea, and this is quite scary, one of our clients has a building that they've retained, and it has an affordable housing unit, and in the last 8 years, it hasn't been leased. And it hasn't been leased because in the market they built it. It was a eastern suburbs location. They basically said that they could only lease to certain types of, certain people, right, and under their means testing of wage and what have you. And they said, well, why would we pay, call it 20, 30% less than what the market is when we can go lease a red brick older apartment around the corner that's cheaper?
With probably 50% of the cost of what that new one
Correct.
is. And there's no market for that affordable, so to speak, product.
Yeah, and I wish kind of the councils and governments will listen to some of this, because it's live feedback, and that's bad.
Like that's empty apartments just sitting there because there's no one who qualifies to live in it.
No. And there's apartment blocks now that are ready for people to move into and can't get OC.
Yeah.
Can't get, their CCs are taking longer, everything's taking longer. So I think for us, it needs to be state driven as well, like they've been doing with the Todd, but they need to fast track things a lot quicker. And I think, like Anthony said, to build a 1-bedroom apartment does not make sense anymore. 2 bedrooms just make some money, and then 3 bedrooms, yeah, of course. But
yeah, it's certainly interesting times. I think there may be some disappointment after all this rezoning, and it's been a massive media storm. When the dust settles, I think there could be whole suburbs where it just simply doesn't work, and a lot of time and effort to be left with what you started with, which is just individual houses on 500 or 600 square metres of land.
Yeah, and have amalgamation plays aren't fun. Anthony and I have done a few sales where we've amalgamated 18 owners, 20 owners, and we've sold on behalf of them, and all it takes is 1 or 2 to not want to be a part of it, and then it's all going to fall away. And then you've got some sites that are left in isolation, which isn't great either. So, thank you for listening to our latest episode of the Property Perspective podcast. For more information or any questions you may have, please feel free to reach out to us.
Before you go, subscribe to our channel so you don't miss out on the next episode of The Property Perspective, when we'll be back to share our take on more key trends and topics shaping Australia's property market. You can also follow us on LinkedIn or visit our website at knightfrank.com.au for more information. Thanks for tuning in. It may be the end of the show, but we're always your partners in property.